That is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. We got Lou Bassanis, as well as Yahoo Finance's Ali Canal, joining us here to break down the moves today. Ali, let's start with you on the close.
Yeah, so we're seeing a mixed picture here across the board. The Dow closing in the green, though, up about 0.9% or 400 points. We saw the NASDAQ, the biggest laggard of the session, down about 0.8%. And the S&P 500, which was wavering around the flat line most of the afternoon, closing down about 0.1%. And earlier today, we got a slew of economic data, including some positive developments on the labor market side. Job openings hit their highest level since November 2024. We also saw the quits rate edging lower. So that paints this picture of a solid labor market heading into that crucial labor non-farm payroll report on Thursday. But we did also see the passing of Trump's one big beautiful bill in the Senate. And to that point, we did see some reaction on a sector basis here. So if we take a look at the sectors that we saw the biggest gains and losses, you're seeing materials, healthcare, consumer staples, all in the green, communication services, and tech leading the declines there. And tech is something that I've been watching all day, because after this bill was passed, there was a strike down of a provision which would ban state-level AI regulation. And that's something that the tech companies out there were really pushing for. A lot of those executives had supported President Trump. So that is a detriment to tech overall. But if we take a look inside of the NASDAQ 100, you'll see there's some pretty sizable losses for a name like Meta, 2.5% lower, Broadcom off about 4%. And then Tesla, we've been watching this one. I mean, this stock has just struggled since the start of the year. But let's take a look at a 10-day period, because you'll see this drop off here. We are down about 9%. Obviously, the EV tax credits on this one big beautiful bill, that's something that will directly impact Tesla's bottom line. We know CEO Elon Musk, he's been very critical of President Trump, and really since the demise of their relationship, we've seen this back and forth volatility with Tesla shares. So a lot to keep track of today, but again, all eyes are focused on that labor market print later this week.
All right, thank you, Ali. Lou, bringing you here back, looking at the popular average, Lou, finished basically mixed here. Get your thoughts on today's trade.
It's not a technical term in investing, but it's meh. You know, it's the response to the big, beautiful bill. I think it just shows that it was priced in. Everyone was expecting this. The deadline was going to get met. It's priced into the stocks here. You see a little bit, like Ali was bringing up, in the tech space, because that AI regulation at the state level got struck. Maybe some downside risk there, but nothing really alarming that I see here. So, and I think the market's response confirms that.
When you had all the hot talk, though, Lou, including from Elon Musk, and you heard from a lot of fiscal hawks, too, in the House about what this bill meant for debts and deficits, how do you think about the reaction you're seeing in the bond market, which has given this a giant shrug so far? Yeah,
I think it's just something is better than nothing, right? I mean, I think the thing that's most concerning to me is when it came from the House to the Senate, they increased the debt ceiling by another $1 trillion. So a $5 trillion increase to the limit. It just shows that Washington's going to keep spending. That's your trajectory. So the bet here is that we can outgrow, or at least grow enough. Right?
Because the CBO gives you these projections. It's going to add, I think, what was it, 3.3 trillion. And I guess the pushback you heard from the administration has been, well, we just disagree with their growth projections.
Yeah, and look, the CBO's projections, if you chart them, they have not been very accurate. They're overly optimistic, so it's probably even bigger than that 3.3 trillion debt deficit increase. But again, all to be determined. There's a lot of variables here. I think the things that were prudent were just pulling back some of those subsidies for solar and wind, just because it was a huge number. And we got to get to a point where we invest in innovation where it makes them economically feasible. And that's happening. It's going to force industry to do that. Without a mandate, you're not motivating anyone to do it. So now they've mandated, hey, you're going to stand on your own economics. I think you'll see that happen in the solar and wind space.
The other big date on the calendar, Lou, is the one coming up for tariffs, right? We got another deadline fast approaching. I mean, the White House did suggest that's not really set in stone. We'll see how that plays out. How are you thinking about that as an investor?
Yeah, I mean, it's kind of a Chicken Little situation, right? We've had an on again, off again, on again trade war and tariffs here. The president saying that, with Canada, I'm just going to send you a letter. I'm done negotiating. So I think we've all gotten used to that. And no one's going to believe that it's going to get dire consequences, especially because we're not seeing it in the data yet either, right? So beginning of this, everyone was worried, a 35% tariff, 135%. What's it going to net out to impact on consumers? I think the key point is really that you're driving towards resolution, because the longer the trade tariffs exist, the harder it is for companies to absorb that cost. What we're seeing now is that companies, the producers, are really taking it on, not so much the consumers.
The interesting point there, I mean, I take your point, Lou. It seems like the market has kind of decided, you know what, it'll be a 10% tariff, and we can live with that. We can digest that. We can move on. Are we being, I guess my only question is, as investors, is there any risk that you're being a bit complacent with it, in the sense that you have no idea? I mean, Trump could come out and say, listen, this guy Xi, he's not giving me anything. He's upsetting me. I'm getting frustrated. That's it. Yeah. I'm ramping it right back up.
Yeah, it sounds like a mob movie. This guy, I'm going to take care of that one, right? I agree with you. So I think you have to fight complacency by looking at earnings, right? Earnings are going to have to, you have to grow into these valuations, or you got to find names that are undervalued that are growing attractively. So again, there's certain sectors that make that more likely. I talk about energy, but I did one of the previous guests talking about small caps. Small caps are expected to go from negative 11% earnings growth last year to 18% this year to 37% next year. If that happens, the Russell 2000 is going to have an epic rally and start bringing back, the outperformance that it had against large caps. So.
Epic rally. Let's leave it there. All right, well, joining us now to talk more about all this, we got Christy Aulian, head of iShares Investment Strategy Americas at BlackRock. In all, BlackRock has more than $11 trillion in assets under management. Christy, it is great to see you. Why don't we start on the news of the day, Christy? The Senate passing the big, beautiful bill now, of course, goes to the House, Christy. I'm just curious how you're thinking about that, Christy. Ramifications for the market, for the stock market, and maybe also the bond market, Christy, long term.
Yeah, absolutely. Great to be here. Thanks for having me back. I think, picking up on kind of the thread that Lou dropped there too, I think that there's a more direct impact to the bond market. I think our takeaway from what we've seen in sort of the fiscal picture so far is that we still remain pretty cautious on the long end of the yield curve. So we like focusing more on the front end, more of the belly, sort of the intermediate duration part. And we're really fixated on the income portion of fixed income right now as well. So something like BINC, our BlackRock Income ETF, we think makes a lot of sense given the sort of clouded fiscal picture that we have from some of the policy changes. The equity side, though, I do think, even just moving past some of this uncertainty can lay the groundwork for a little bit of a relief rally. I know you guys touched on it at the top, but there is still so much uncertainty around the fiscal policy, around the trade policy, and then really importantly for this week, what we're going to get in terms of the data for non-farm payrolls as well.
Christy, on the big, beautiful bill, Elon Musk not happy, making that very clear, Christy, on X, and he calls calls the bill insane. He's most concerned clearly about the debts and the deficits. I'm looking at the 10-year, though, Christy. I'm at 4.25. Do you think we see at some point some pushback from the bond market?
I think that why we're not seeing a ton of reaction right now is just because so much of this has been priced in. So a lot of it has been broadcasted. I think that markets are digesting what these forecasts and these expectations look like, with some awareness that there is a little bit more of a reaction function maybe from the administration and from policymakers than we thought at the beginning of the year. So yeah, I think it warrants keeping an eye on and some caution. But we still think that this is a good time to continue to stay invested and probably to get some cash off the sidelines as well.
What about another date now on the calendar, Christy? That's July 9th, the tariff deadline. The White House has seemed to maybe suggest, okay, that's not set in stone. What's interesting about that, Christy, is the market seems to have decided, listen, Trump has backed off his maximalist position, and whatever gets imposed here we can live with. But I'm curious how you're thinking about it.
Yeah, absolutely. So I really actually think that this can cut both ways a little bit too, right? There is some expectation that we'll get a little bit more certainty as we move past that deadline, either because it gets pushed back or because some things get resolved. I think that the expectations that have been priced into markets already are already for a bit higher inflation and probably for some lower growth. So again, just coming into this, the starting point is that is priced. One of the things that we're watching, and I think is going to matter so much going into the summer is what we're going to get from corporate earnings. So, on that point around the trade policy uncertainty, there's been the big question of whether those higher prices from tariffs are going to get passed on to consumers and manifest as inflation, or whether they're going to get internalized by companies and get manifested as lower profit margins. I think going into Q2, we have a lower bar than we've had for the last several quarters. So we are still forecasting, and the market, street consensus is still forecasting earnings growth. But the expectation this quarter is only for about 4% earnings growth for the S&P 500. If you look back at Q1, the expectations were for 7%, and we delivered 12%. So I think that lower bar could actually present an opportunity for the market to outperform and for U.S. companies to prove that they are exceptional, at least in generating profit. So, we're really watching very closely to look at the hyperscalers. We do believe very much in the AI trend and see that continuing to evolve. Something like the BlackRock AI ETF is one that we're talking about a lot right here, where we're going to get so much more information in Q1 earnings, and we think that can continue to be positive, particularly for the trend of AI and how that has been able to really generate a lot of profits as well as investment in CapEx as well.
So, all right, so hyperscalers, those big cloud giants, the mega trend of AI, Christy. Let me ask you, would you prefer here large cap, mid cap, small cap?
Yeah, so I think that within the U.S. equity markets, we have a pretty strong preference for large cap. We like staying up in quality. We like being exposed to AI. But when we think about the portfolio as a whole, you look to concentration to grow wealth, and you look to diversification to protect wealth. Right now, what we're talking about a lot is really the ways to build more diversification into investor portfolios. And there we like international markets, we like developed markets as a better diversifier to your concentrated large cap US equity positions than something like small caps. We think small caps are going to continue to struggle in a higher interest rate environment. We've seen the profitability profile of small caps continue to decline over the last several years. So we like DM equities, we like European equities as both being lower volatility and lower correlation to US large caps as a way to build out that diversification. So IQLT is a great way to do that. The quality factor internationally is something that we have a lot of conviction in. So it's not just a US story. We really do think that it's broadening out beyond that.
And Lou, I want to bring you in here because Christy says, Lou, those small caps are going to struggle, but Lou, you were a believer in those pint-sized companies, so make your case.
Small caps are the Rodney Dangerfield of finance. They get no respect. And look, I've been banging the table there for a while. I've been early and wrong, so full respect, you've been right on that. I do think there are pockets. You got to look at undervalued revenue-producing ones. There's a lot, particularly in the biotech space, that fall into the Russell 2000 that don't have any. So I think, again, you got to be a stock picker. One thing I will add to Christy that I agree, another data point here for the earnings season that really sets the stage for better than expected performance is that we saw 51 of the S&P 500 companies raise Q2 guidance, right? Even in the face of this tariff tantrum, you're seeing companies be more optimistic about their ability to absorb that and not impact margins. So I think the stage is set again for that 7% expectation in Q1 that showed up as 12%. This quarter it's 4%. Is it 8%? We'll see. Mm-hmm.
Christy, before I let you go, we almost went the whole interview, Christy. I didn't ask your views on the Fed. Where is the Fed here? Because we just heard from Jay Powell today, Christy. You heard that. He said, listen, we could have been cutting except for those Trump tariffs.
Yeah, wish we all could have been in Portugal today with him, right? Our view has been that we're gonna see some more easing later this year. Really, that's been firmed up in market expectations. I think our view is still for September, probably 2 cuts this year. July, maybe came back on the table a little bit, but still seems like a pretty much of a long shot for us in terms of what we're gonna get. So holding into September as the next cut is our forecast there.
Christy, always great to see and to have you on the show. Thank you.
Thanks for having me.
Well, hitting the road may not pinch the wallet as hard at the pump this 4th of July holiday weekend. Gas prices on track to hit their lowest level since 2021. Senior markets reporter Inez Ferre joins us now with more. Inez.
That's right, Josh. Drivers that go to fill up at the pump this holiday weekend will see prices similar to the ones they saw during this time of year back in 2021, 4 years ago. The national average of gasoline is right now at $3.17, according to AAA. A week ago, it was a little higher than that. But take a look. A year ago, it was quite higher than that, more than 20 cents higher than that. And part of this, of course, has to do with oil prices that have been trending lower, even though we've seen some volatility in June. One energy expert has told me that you can expect to see some wobbling around in July and also in August. A lot of disparity when it comes to what different states are paying, what the drivers in those different states are paying. California is still the most expensive state for gasoline, with California at $4.58, still lower than last year. But remember that California has a lot of higher taxes and fees because of their green initiatives. They also have an issue, and that's 2 big refineries that are expected to close. But on average, energy experts are telling us, look, you can expect to see gasoline to trend lower going into the fall and below $3 per gallon on average by the time that the fall hits, because you have less driving around that time of year. You also have the less expensive winter blend that's kicking in. And of course, you've got OPEC Plus, which has been increasing supply. So that has been putting pressure on oil. And year to date, we're looking at Brent down 11% and WTI down 10% year to date. Josh?
Thank you, Inez.
Thank you.
Well, stick around. Much more market domination overtime. That's coming right up. Cloud-based collaborative web design platform Figma files for an initial public offering in the United States. Plans to trade on the New York Stock Exchange under the ticker symbol FIG. Figma has yet to disclose how many shares it's planning to sell in the IPO, but the company was valued at $12.5 billion in a tender offer last year. Figma was founded in 2012 by CEO Dylan Field, who said in a letter to investors that it was time for Figma to buck the trend of many amazing companies staying privately indefinitely, and added that as a public company, investors should expect us to take big swings, including through acquisitions. Revenue in the first quarter for Figma increased 46% year over year, and as of March 31st, it had over 1,000 customers, contributing at least $100,000 a year to annual revenue, up 47% from a year earlier. Morgan Stanley, Goldman Sachs, Allen & Company, as well as JP Morgan will act as joint lead book running managers for the proposed offering. Well, the U.S. and China keen to ease tensions before tariffs rise further on August 9th, when broader duties could rise 50%. Two nations already confirmed details of a trade framework that involves rare earth exports and easing of tech restrictions. For more on what might lie ahead and the potential investing plays, let's get to CraneShares CIO Brendan Ahern. Brendan, it is always good to see you. So we've got talk of a trade framework, Brendan, a trade truce, a trade handshake. I think investors front and center, Brendan, they want to know, listen, when are we going to get a big final trade deal between the U.S. and China? What do you think?
Yeah, again, this is just a reaffirmation of that original deal back in early June that kind of went off the rails, and we kind of got it back in order. There has been some chatter that you could see a state visit. I think it's undecided that the two heads of state have each invited one another to visit Xi to the U.S., Trump to China. For China, this September is the 80th anniversary of the end of World War II. So there's some chatter, some talk about would President Trump be willing to travel to China for the end of the World War II celebration in China 80 years ago. And certainly President Xi has on numerous occasions spoken about the flying tigers.
Who do you think, Brendan, has the leverage here, U.S. or China? I had a policy guy on this week on the show who said he argued with Xi because he could take a much more longer-term look. He is not worried about polling. But what do you think, Brendan?
Yeah, I think there's no winner in a trade war. Certainly, U.S. consumers are the biggest losers, U.S. retailers. At the same time, China, it is a very big country, not just geographically, but economically. And so, yeah, there's parts of China that are not geared to export manufacturing at all. We estimate that less than 3% of China's GDP is geared to the United States today. That percentage has come down pretty dramatically as Asian countries, as well as the European Union, now biggest trader partners. But I think ultimately there is no winner. And these two economies are highly intertwined with one another. Business people are getting along with one another just fine. Why can't these diplomats take a page from the corporate world?
So given these trade tensions, Brendan, right, these trade tensions, which as you argue, hurting everybody to some respects, How does that then, Brennan, inform your investment decisions? What Chinese sectors, industry names do you want exposure to?
Yeah, I mean, certainly we believe that the Chinese government will pivot to raise domestic consumption to offset export-driven manufacturing, where it's going to face a little bit of a headwind. Certainly, just with the reprieve in the trade war, you've seen some of the China PMIs have been rebounded quite nicely. But in general, I think this is an area where President Trump and President Xi agree that China needs to do more around domestic consumption. So they're doing a lot of consumer subsidies. Those subsidies have been geared to auto, which includes electric vehicle and hybrid. More recently, it's electronics. So things like iPhones and mobile phones, smartwatches, as well as home appliances. So I think those are three areas around consumption that, as an investor, you want to be focused on when it comes to China today.
You mentioned EVs, Brennan, and there was this really interesting comment from Ford's Jim Farley. I don't know if you saw this, but he was talking about the Chinese EV industry and how he's made multiple trips over there. And then he said this, Brennan, he said, "It's the most humbling thing I have ever seen," he said. "They have far superior in-vehicle technology." What do you make of that comment?
Yeah, I think as a fellow alum of the same high school as Mr. Farley, I think we're in agreement that I think when you travel to China and you go to Shenzhen and visit BYD, these really are amazing vehicles. It's not just pure high electric vehicle; they're actually doing a lot in hybrid. There's a lot of chatter that Farley of Ford actually they bought a Xiaomi car and to kind of compare it to what Ford's been working on. And he actually kept it. That's his daily driver because he enjoyed it. I think at the same time, I think this is where President Trump, as a business person, working with the U.S. business community, why not allow Ford partner with CATL, China's big battery maker, leverage that technology and build that here. Let U.S. consumers, U.S. companies benefit from some of this intellectual property developed in China.
You know, finally, Brennan, I was talking to an American tech CEO recently, and we were chatting about AI, and he said, listen, the U.S. leads on AI. We play point in AI. I'm curious whether between U.S. and China, is that how you see it, Brennan? And more importantly, is that how you continue to see it developing from here?
I think DeepSeek shows that innovation is not a uniquely American trait. I think if you look at some of what the people at Anthropic have said about DeepSeek, this is beyond just some sort of stolen copycat. This is real technological innovation that's taken place in China. And again, it's only if you want to view the world as this black and white, there's winner versus loser. I think we can all benefit. I think the next leapfrog is going to be around robotics, which again, I think there's going to be great U.S. companies are going to do very well in the humanoid robotics space. There's going to be great Chinese companies in the space as well.
Brennan, always great to see you and to have you on the show. Thank you so much for joining us.
Pleasure. Josh.
That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to after the closing bell. Also want to thank the great Lou Bassanis, was here all afternoon with me. Lou, final thoughts for the audience.
Yeah, listen, piggybacking off of Brendan here, I think you got to play AI and the hyperscalers. You've seen CoreWeave express an interest in Core Scientific making, there's rumors of a talk there. There's other players in that space that have gone from Bitcoin mining to hyperscaling. I also like the AI. A good data point to anchor on is it's a race that's changing pretty much every week. China has the most patents. They filed about 13,000 last year. The US was at about 8, but the US patents are being cited more often and turned into companies more often. So I think in the world of AI, you have to be opportunistic, look for those new companies that have strong IP that protects them.
Lou, great having you today.
Great to be here.
Thanks for joining us. Don't go anywhere. On the other side of break, it's Ask for a Trend. Got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.